If you're under 60 years old, I have urgent news for you, and it's terrible. Your financial advisor, your retirement plan, your retirement spreadsheets, all of them are preparing you to die at the wrong time. You are planning for your financial life to end at 80 years old. But longevity science is advancing at an exponential pace, and it simply will not allow you to die at that predetermined age. We are on the edge of a technological revolution, a biological breakthrough. Advances in genomics, AI-driven diagnostics, and cellular therapies mean that health span longevity, living free from major chronic disease into your 90s, is becoming a statistical probability, not a distant dream. The new greatest enemy of your wealth is no longer market volatility or a simple recession. The one thing that will almost certainly destroy your portfolio is the thing you want most: time. Your greatest enemy is longevity risk. So what exactly is this risk? It is the deep financial mismatch between your capital runway and your biological life expectancy. It is the terrifying scenario where you live to 95, 100, or even 110, and discover that the capital you spent your entire life building ran out at 82. You will have 2 decades or more of healthy, vibrant life left, but you'll be financially dependent. This isn't just a financial risk, it's a freedom risk, where your extended years become years of anxiety instead of enjoyment. In this clear and comprehensive guide, I'm going to show you 3 things. First, the terrifying chart that proves your early financial collapse. Second, why traditional strategies, like relying on fixed income or standard 401k products, have been made obsolete by the longevity curve. And finally, I'll introduce the 3 essential asset classes you must hold today so your money lasts as long as you do. Stay with me until the end, because the third asset is the most ignored by traditional investors. And it's the key to building cash flow that learns how to age, giving you perfect protection against the greatest financial threat of our time: the big lie and the scary chart. The planning mistake we're making is rooted in history. For decades, traditional financial models, including the 4% withdrawal rule, were fundamentally built on the assumption that you would die relatively young, usually before age 85. Living to 80 was the statistical norm, living past 90 was the exception. That model worked in the past. It allowed you to retire peacefully, slowly drawing down your nest egg without needing significant growth afterward. But relying on that historical model today is an act of financial negligence because the assumption of a short lifespan has completely collapsed. Imagine this real-world scenario. You plan to retire at 60 with savings designed to last 25 years. That takes you to age 85. But what if the longevity revolution holds, and you feel healthy at 85? You've just added 10 to 15 extra years of life. That sudden extension is the failure point of the standard 80-year plan. Your capital, which was supposed to be preserved, now has to fund an entire extra phase of life. Look at this chart. This line projects the bankruptcy trajectory of the average investor relying on outdated advice. The cutoff point, where the line hits $0, comes far earlier relative to your potential lifespan. It's a ticking clock that most people only see when it's already too late. Why does this failure accelerate? It's not just extra time. It's the lethal combination of time plus longevity inflation. What becomes your most expensive cost at 85 or 90? Healthcare, specialized care, premium health maintenance, anti-aging treatments. Healthcare inflation runs significantly higher than the standard consumer price index. If your money earns average returns, it simply won't grow fast enough to outpace the rising costs of a longer life. If your growth doesn't beat healthcare inflation, your retirement is already doomed. Longevity risk demands an immediate and radical shift in perspective. You must change your financial mindset from timid preservation to aggressive, consistent growth acceleration. The failure of fixed income. When fear sets in, and the fear of running out of money in old age is deep, the instinctive reaction is to seek safety. For decades, that safety has been fixed income, treasury bonds, CDs, and other low-risk instruments. And that's exactly why fixed income has become a fatal mistake for anyone planning a 100-year lifespan. Fixed income creates the illusion of safety, but delivers painfully slow growth. It protects against market crashes, but offers zero protection against the slow, silent killer known as longevity inflation. You are trading short-term volatility for long-term purchasing power annihilation. Here's an analogy. Trying to fund a potential 40-year retirement, from 60 to 100, using fixed income is like attempting a marathon in a slow, inefficient car. You'll feel safe on the road, but you'll run out of fuel halfway and be stranded. You need a vehicle built for extreme distance. The hidden cost of traditional fixed income isn't just low yield, it's the massive opportunity cost you sacrifice during the most powerful compounding years of your life. Between ages 30 and 60, your capital should be working at maximum intensity. Locking it into low-return assets guarantees a retirement shortfall. Worse, traditional bond ladders assume a smooth, linear withdrawal path, but healthcare costs are non-linear. One major health event at age 88 can instantly erase a decade of careful planning. Slow-growing fixed income cannot absorb shocks that sudden and massive. You cannot wait until retirement to adopt a growth mindset. The era of passive accumulation through modest interest payments is over. To defeat longevity risk, you must build a portfolio designed to grow exponentially for 30 years, and then generate income that grows dynamically for the next 40. That's why a longevity portfolio cannot be traditional or monolithic. It must be a sophisticated structure built on 3 completely different pillars. These pillars are your strategic defense and your relentless offense against the inevitability of time. The anti-aging bet. The first required asset is the most counterintuitive for traditional investors. The anti-aging bet, a strategic high-growth investment in biocapital. If you personally benefit from living to 100, your capital should also be invested in the companies making that future possible. This is the definition of a survival hedge. Your investments profit if you live longer. We're talking specifically about companies attacking the root causes of aging itself, including genomics and personalized medicine, senolytics that remove old dysfunctional cells, AI diagnostics that predict and prevent disease years before symptoms appear, dramatically reducing future healthcare costs. This asset class is positioned for massive exponential growth because the market for extending human health is literally worth trillions of dollars. The financial return is directly tied to a biological paradigm shift, a powerful narrative that supports decades of upside. This growth asset should form the core of your acceleration engine during your working years. You are investing in the future you expect to live, ensuring your wealth scales alongside your health span. But a critical warning, you must filter the hype. This is not about chasing trendy supplement companies. It's about deep foundational technologies scientifically targeting aging mechanisms. You are investing in science, not marketing. Biocapital is the ultimate growth engine traditional advisors, still stuck in the old world, cannot or will not offer. It is the necessary risk component that allows your portfolio to outrun healthcare inflation. The survival risk hedge. While asset number 1 is your high-octane growth engine, asset number 2 is your core defense, the survival risk hedge, implemented through strategic allocation to real assets. If you expect to survive economic volatility for 40 years after retirement, part of your capital must be anchored in assets that cannot be digitally erased, printed by governments, or destroyed by systemic financial crises. You need tangible, physical wealth. This is not a simplistic call to buy gold. It's a nuanced strategy. Gold and select commodities serve as ultimate stores of value, non-correlated anchors that preserve purchasing power during market panics. They act as insurance for the portfolio. Next is strategic real estate. Not passive residential rentals, but properties in high-demand, longevity-driven niches, specialized medical facilities, senior housing in high-quality regions, or land supporting essential infrastructure. These assets generate stable returns independent of volatile equity markets. Finally, infrastructure assets, utilities, essential energy, and telecommunications. These provide services critical to human survival and long life, delivering highly stable, utility-like cash flows and acting as buffers against economic and geopolitical instability. The beauty of the survival risk hedge is that it doesn't just protect, it creates peace of mind. By anchoring part of your wealth in non-financial physical assets, you ensure that even in the most extreme 100-year lifespan scenario, your core purchasing power remains intact. This asset class stabilizes the volatility of biocapital while protecting against the inflationary forces that accelerate the cost of a longer life. It is the solid foundation of your longevity portfolio. The passive income pill. The third asset is the ultimate solution for late-life cash flow, but it must be fundamentally upgraded. Passive income 2.0. The greatest failure of traditional passive income is that it's static. Fixed dividends and bond yields lose value every year to inflation. If you're going to live to 100, your income can't be a stream. It must be a river that widens every year. That means abandoning fixed-rate assets and focusing entirely on dividend growth investing. You must own durable, high-quality companies with proven histories of increasing dividends annually. This strategy forces your income to outpace longevity inflation. A $10 dividend today must automatically grow into $50, $70, or even $100 over 30 years just to maintain purchasing power for healthcare and care expenses. That is non-negotiable. In addition, we layer in capital leasing strategies. This means generating recurring cash flow from high-growth assets, like biocapital, without ever selling the underlying investment. Strategies such as covered calls and other income-generating derivatives allow your growth engine to double as an income provider. This modern approach solves the core problem of longevity risk. It replaces the exhausted, shrinking cash flow of traditional income models with a dynamic stream that automatically adjusts to the rising costs of a longer life. The combination is powerful. Growth assets expand the base. Real assets provide stability. Passive Income 2.0 delivers an inflation-adjusted growing paycheck. This final pillar ensures your money doesn't just survive, it thrives alongside you. You've seen the chart, now you understand the existential threat of longevity risk. The 80-year planning error is widespread, and it will destroy the financial freedom of those who fail to adapt. The clock is ticking in the most important accumulation phase, the window where compounding does its magic. The time to change your mindset and portfolio is not 5 years from now. It's today. Your mission is clear. Rebalance your wealth around the 3 longevity assets: bio-capital for aggressive growth, real assets for maximum defense, passive income 2.0 for dynamically growing cash flow. This is the only way to ensure your capital runway matches your biological runway. To help you take the next step, I've created a detailed 5-point plan showing exactly how to allocate capital across these 3 pillars, with ideal percentages tailored to different age ranges. This plan is your blueprint for a longevity-proof retirement. It's completely free. Click the first link in the description to download the Longevity-Proof Retirement Guide. Stop planning for yesterday's life. Start investing for the 100-year life you deserve. Don't let your money die before you do. Join the movement. Like this video, subscribe for more longevity cash flow insights, and comment below telling me which of the 3 assets you'll explore first. I'll see you in the next video.